China promises more support for exporters as data suggests cargo shipments have fallen by as much as 60% since the U.S. imposed 145% tariffs on Chinese goods. Banca Generali shares soar after a surprise takeover bid by Mediobanca in what could be a defensive move against its own takeover by Monte Paschi. Plus, while voting set to begin in Canada following an election campaign shaped by Donald Trump's tariffs and his calls to make Canada the 51st state. So there's quite a lot going on. It's a busy week, actually, in terms of data out of the U.S. So we'll have a lot of Fed speakers, FOMC, definitely left, right, and center. The topic du jour when it comes to any moves on yields. Now, look, overall, it's very clear that Trump's China tariffs set to unleash the supply shock as we have some of the data coming from the U.S. economy. I'm looking at S&P futures, they're down 0.3%. Look at the 10-year actually yield in the U.S. at 4.25, and then gold, something that we watch out as a diversification away maybe from treasuries, gold at 3,287. Now, European markets, this is a picture overall. Again, we had quite a volatile week last week. We're in the middle also of earnings season. So, look, European stocks rose some 0.5% overall. You can see the FTSE's gained 0.3%. The CAC 40 gaining some 0.4%. Economic data, investors also watching for any signs of progress when it comes to these trade negotiations. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Chinese officials have vowed to provide more support for exporters affected by Donald Trump's tariffs. The move showing greater urgency to shore up the crucial sector as signs of distress emerge. Now, let's get more with Bloomberg's Joe Dices in Hong Kong. Joe, so what more do we know about China's latest policies to support the economy?
Well, so really at this point, Francine, what we're seeing is some more this idea of providing more targeted loan support for a lot of these exporters that are affected by these tariffs, sort of this idea of boosting domestic consumption. So it seems like what these Chinese officials ultimately have in mind is that they need to figure out a way to offset the impact from the Trump tariffs, obviously. And so whether that comes in the form of, figuring out other ways to shore up how these exporters are doing, try to figure out how to boost their ability, to provide supply to those within China domestically. That's kind of the idea here. The thing that I would caution, though, Francine, about some of these measures that we heard out of China today is that while there's a little bit more detail in there, a lot of this does seem a bit reiterative. So ultimately, it's not like it's some giant stimulus boost that China is providing to its exporters. It does kind of show that they're at least kind of holding steady when it comes to that sort of support. But again, I think, as you were highlighting at the top of this program, when we're looking at the amount in which exporters are really kind of losing out when you're seeing that the amount of shipments going to the United States has fallen so dramatically, it does kind of highlight that the American consumer is certainly going to start feeling the pinch here. And it does highlight that, at least from the China side, there's some measures of support, but they're still being a little bit measured in terms of how they ultimately are watching the situation unfold, obviously, and we still have to see whether or not there's any kind of deal between the U.S. and China when it comes to maybe negotiating down the rates of those tariffs sometime in the future.
Jill, meanwhile, there's a lot of course, tensions between the U.S. and China over the Panama Canal, and that really appears to be worsening. Can you unpack the latest?
Yeah, so really, Francine, I think a couple of key details on this unfolding incident that, you kind of want to look out for starting from the weekend. Now, as we know, Trump has really made kind of reclaiming the Panama Canal, this idea of reclaiming the Panama Canal, really central to the first few months of his administration, continues to bring it up. He's lately, suggesting this idea, that the U.S. should be able to sort of pass freely through the Panama Canal. A lot of this kind of comes down to the fact that a couple of those ports within the canal are owned by a Hong Kong-based company, CK Hutchison. That company had earlier agreed to sell those ports to a company, a group that's backed by the American investment firm BlackRock. The latest here, though, is that China's market regulator is actually looking into that deal to kind of see whether or not they want that to go forward. China has been very unhappy with this company, for the prospect of selling off of these ports, and so that continues to be kind of a central point of tension, particularly as we see, Trump kind of, revving back up and, bringing a lot of his thoughts about the Panama Canal, this idea of potentially reclaiming that kind of back into focus. So you do see, again, there's obviously lots of points of tension in the U.S.-China relationship, but this is just one more that kind of shows how that continues to simmer there, particularly against the backdrop of all of these tariffs and the fact that we still haven't really gotten a whole lot of clarity on what exactly, this relationship on trade and all of these other issues is going to ultimately look like going forward.
Jill, thank you so much. As always, Jill Desis there with the very latest on China. Now, cargo shipments from China to the U.S. have plummeted since, of course, Donald Trump raised levies on China. Now, Bloomberg found the number of ships headed to the U.S. is down 40% from early April. The president believes a trade deal with Beijing is still possible.
They want to make a deal, obviously. Right now, they're not doing business with us. People talk about going cold turkey with China, meaning just forget about it. We were losing hundreds of billions of dollars a year with China, and now they're not doing any business with us, not because of them, because of me. Because at 145%, you can't do business. But something's going to happen that's going to be positive.
Well, let's bring in Brendan Murray, who leads Bloomberg's trade coverage. Also here with us, Themos Fiotakis, Global Head of FX Strategy and EM Macro Strategy at Barclays. So thank you both for joining us. Another Monday, another trade conversation. Themos, everything's moving basically on the fact that also China's saying, look, it's not in trade talks with the U.S. So optimism from the U.S. and China kind of pouring cold water on it. What's the market thinking?
I think the market is quite skewed at the moment. The market is assessing the damage to the U.S., the damage to the U.S. consumer, the damage to the U.S. credibility, while it thinks that ultimately China can work through its problems through stimulus one way or another, or find some way of striking some kind of a deal. I tend to think that that conversation is a little bit skewed. I think the market doesn't think of the long-term issues that are starting to emerge for China on this count, basically.
Brendan, where are we on the negotiations? Are there negotiations? I know there's always been differing accounts from both parties, but it feels like we're really far apart.
Yeah, it depends on who you listen to from the administration or from the Chinese side. There very well could be some low-level back-channeling discussions going on. But in terms of anything substantive that would lay out a blueprint for talks, that doesn't appear to be happening based on the sources that we talk to. I think what you're seeing in the Chinese shipping data is essentially the rubber hits the road here. You talk about 145% tariffs for the past several weeks. Those ships, American importers are not doing business with China anymore because it's more than twice as expensive. So they've canceled these orders, or they've try to go elsewhere, Thailand, Vietnam, to try to get around those tariffs. And what we're seeing now is the impact of that initial wave of decoupling that will continue to happen if those tariffs don't come down.
Themos, again, we have, a lot of earnings that kind of look at the U.S. trade policy impact. We also have 4 of the Magnificent 7 tech companies due to report earnings this week. But you see tension in treasuries. There's really no part of the market that's been spared. Is this crunch time? This week we're getting data where maybe the Trump administration understands to what extent the damage has been done.
Maybe, yes, maybe it's a little bit early. Maybe, we're going to get to see it over the next couple of months. After all, maximum impact in our forecast is probably going to be around Q3. But I would say that, this cuts both ways. The market is convinced that this is the end of the U.S. investment kind of a trade. If earnings keep coming in at a high level, and that's, a possibility, particularly for the Magnificent 7, then, it could shake some of the logic for the market that is in a disinvestment mode from the U.S.
What happens to dollar?
I don't think that the dollar is on a permanent depreciation path from here. I think the dollar is going to be weak for the time being, maybe around 115 in our forecast for the time being. But I think that the market is very, very short the dollar. He's very convinced that this is the end of U.S. exceptionalism. And at the end of the day, if you strip this down to its core, this is a shock where most forecasters are estimating it's a 50 to 100 base points hit to inflation and something like a 1% hit to GDP, one-off, and then we move on. And a lot of the companies also in the higher brackets of capitalization are unlikely to be super affected by it. So that can be that can cause some rethink in a market that is very much one way.
Bernard, I mean, holistically, where's the Trump administration actually on tariffs? We have, stories day in, day out of U.S. shoppers also paying for, some of the tariffs because, for example, Temu is doubling some of the prices. We're seeing similar amounts from Shein. We see the president's popularity go down. Has there been a shift in language on what they want to do for trade?
Yeah, it sounds like they're really, the clock is ticking, really, to get some of these trade deals done. The president and his advisors have talked about Japan, Korea, India being sort of on the fast track. If the Trump administration can deliver some of those in the next several weeks, or agreements in principle to keep discussions going that bring some of those reciprocal tariffs down ahead of the deadline, July 8th, then there could be some clarity that the strategy that has been quite confusing and disruptive until now, might be able to see the light at the end of the tunnel to where the Trump administration is going. If not, and a lot of people believe that trade deals take a long time, they're complicated, and they don't get done in a couple of weeks, then we're looking at a more prolonged period of disruption. Consumers are going to start to feel it. The Fed is going to have to start taking it more into account as something other than a one-time shock to the economy.
Themos, do you think there's any permanent damage from the trade war and the unpredictability of U.S. policy despite a possible turnaround? So, when you look at U.S. assets, will it change this year?
Yeah. No, I think that if we continue on a place where, it's very unpredictable, it's very disruptive, it's very... it comes out without any kind of logic to it, to the policy, then yes, over time there's going to be erosion and damage. But in the here and now, we get very mixed messages from different kind of asset allocators. There are some who are concerned, there are some who are not fazed by this. I would also add that ultimately, it seems that we're moving towards a place where these policies start to make a little bit more sense, in the sense that, a lot of the reciprocal tariffs have been pulled back. Between Canada and Mexico, we're working towards a result that enhances the USMCA participation potentially. And we were always thinking that China would be the ultimate confrontation stage for the U.S. So to some degree, if this starts shaping up in a place where markets can understand it, can quantify it, then I think that things are going to normalize from a different level of asset prices.
Is there a risk premium that you think investors should be attributing to U.S. assets?
Investors are attributing a risk premium to U.S. assets at the moment. I mean, it is quite hefty. You look at the gap between U.S. yields and European yields. You look at euro-dollar versus fair value. You look at the damage to U.S. equities, either in dollar terms or in non-dollar terms this year, valuation adjustments, etc. There has been a pretty significant adjustment. Now, obviously, if we remain on a very volatile policy path, that risk premium could increase. But we're not pricing zero here by no stretch of imagination.
Brendan, what can you tell us about the other 17 key partners that they're negotiating bilaterals with? Again, these take years, but maybe they could speed it up. But in certain cases, they already have bilateral agreements.
Yeah, exactly. There's another tack that countries are taking, and that's time is on our side. That the longer we drag this out, the more economic pressure Trump is going to feel. That slow walking this will work to our benefit. We see this with Canada. Now they are obviously going through an election, and there's the political situation there. But Canada is saying, we don't need to be in a hurry. The UK, it's not going to face a reciprocal tariff increase like a lot of the other countries are, but it's saying we'd rather have a good deal than a fast deal. And the European Union came away from their initial talks with Washington thinking they were more confused than they ever were about what the U.S. wants from the European side. So those look to be on a longer track. Obviously, important trading relationships, as important in some cases as the Asian economies, but those look to be on a much slower pace.
And Themos, how do you play all of this? Again, I don't know how first of all, you play China, but also in terms of currency pairings, is there something to be done with sterling or euro?
I think both make sense, both angles. I think since the beginning, we have taken two main avenues to trade this. The first one is we do think that the damage to China assets, etc., is underpriced. So we have been short renminbi. You can do that versus the dollar or other major currencies. Received rates there and steepeners and so on and so forth. But also we have been favoring non-cyclical currencies, safe havens, versus cyclical currencies. And at the moment, they both give you an opportunity. Things like the yen, things like the pound, to some degree relative to other cyclical currencies, they have taken a little bit of a pullback, and vice versa. A lot of cyclical currencies, whether it's the Aussie or other kind of cyclical currencies, they sit on a high level, assuming very little cyclical damage globally. So being short cyclical currencies and long safe havens, there's entry levels even here too.
Okay, thank you both for joining us. Bloomberg's trade czar, Brendan Murray, and Themos Fiotakis, Global Head of FX Strategy at Barclays. Coming up, Banca Generali's biggest gainer in the Stock 600 after a surprise takeover bid by Mediobanca. We'll dig into the latest potential Italian banking deal next. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, Mediobanca has launched a surprise takeover for Banca Generali, the wealth management arm of the Italian insurer Generali. Now, it's the latest development in a wave of potential deals sweeping Italy's financial services sector. Well, Mediobanca's bid is seen as a likely defensive move as it fends off takeover interest from Banca Monte dei Paschi. So let's get more now with Chiara Albanese, our Italy bureau chief. Chiara, it's so good to see you. I mean, it's very complicated because there's 1,000,001 shareholders and people wanting to take other people over. It's a very Italian affair. So why has Mediobanca launched this offer for Banca Generali?
Thank you, Francine. As you say, is complicated, and this new deal, this new bid comes just as one in a tangle of deals currently ongoing in Italy. But the short answer to your question is this is a defensive move by the CEO, Alberto Nagel. He is becoming a predator, just not to be prey. And the other deal on the table, which really affects this one and is intersected with this one, is the Mediobanca becoming a target for Banca Monte dei Paschi. So this is where those two deals crossed over.
So how would this strengthen Mediobanca? And again, because of the interlocking bids, what are the consequences of this?
Yes, so this is actually a very good move and a good defense strategy for Mediobanca. It is a good deal for the bank itself. It's not only a defense, because buying Banca Generali, which is a little gem, a wealth manager, would allow at the same time not only Mediobanca to take over a good business in terms of wealth management, which combines very well with its own business, but also to swap out its stake in Generali, the insurance company, which is also subject of several deals. And it is a stake that Mediobanca is not really maximizing in terms of its shareholders. So it allows to maximize and improve its stakeholdings at the same time. So it is part of a wider strategy, but one that could make the little bank, the Mediobanca, which is a name that itself is at the center of a lot of plays, very compact and very well placed.
Chiara, thank you so much. Chiara Albanese there with the very latest, of course, on this Italian possible tie-up. Now, investors will be looking for clues on the impact of tariffs as European automakers report this week. Now, let's also bring Horst Schneider, head of European Automotive Research at Bank of America. Horst, thank you so much for joining us. It's a big week for earnings. It's a big week for tariffs. It feels like automotive and the automotive sector has been one of the harshest, actually, sectors hit by everything that's been going on over the last 2 months. How do you see this playing out?
Yes, exactly. Auto suffered a lot, even though recently we also saw a nice pullback. So therefore, I think the market is not clear how the situation develops. We have calculated all the tariff impacts in our note beginning of April, and we were pointing out that basically EBIT margins could decline by 2 to 4% in the worst case. So if the tariff situation remains unchanged, could be even worse if also the parts get charged with an additional tariff. That's not yet our assumption, but it seems that the market is not yet fully pricing that in. So therefore, I think the market at the moment wait and see stance and wait for the news flow.
Who's better positioned to actually cope with Trump's tariffs?
Well, those car makers producing in the US or not trading at all with the US. That's a shortish answer I can give. But of course, I mean, in the end, if you are exporting to the US, then all of them going to be affected. It just then depends on what percentage of sales is really generated in the US, what percentage of the imports really, or what percentage of US sales really come from the imports. With that regard, we have flagged that, of course, the luxury car makers, they are the most affected. Companies like Porsche, which are generating something like 25% of the sales in the US, Ferrari, Aston Martin, 30% of the sales in the US. But of course, the luxury car makers also have got price power. So therefore, it's a question at the moment, when do the car makers raise the prices? And we have not yet seen these announcements, except from Ferrari.
I mean, we'll have, and I think actually we may speak to the chief executive of Ferrari tomorrow. But when you look at some of the companies that will come out with earnings this week, Porsche, Volvo, Mercedes, Volkswagen, again, they have very different cars. They have very different components in the supply chain. Is there anyone that will actually do better than the others? Is this also going to launch a wave of consolidation amongst European car makers?
Of course, if you look at the production footprints, then clearly BMW is still one of the better positioned companies because they have got the largest global plant in the US, that's in Spartanburg. Nevertheless, also BMW imports vehicles, and the US is not looking at the net trade balance. The US is looking at the gross import figures. So therefore, even those companies producing locally, they are affected. But nevertheless, if I have to put the Germans in order, then I would say still that BMW is rather better positioned. Mercedes is a little bit worse. Volkswagen is kind of in the middle. It depends if also the imports from Mexico get charged with the tariff. A lot of ifs and whens and a lot of questions still. Uncertainty is high. But if you also ask me what kind of guidance revisions we could see at Q1, I think a lot of companies even not warn yet on the guidance because they are still in a wait-and-see mode, and they just take the current tariffs and wait for some change. So therefore, I think guidance revisions not going to come for the time being. That's going to take some time.
I mean, even before all of this, the EU is raising, levies on Chinese electric vehicles. How's that working out?
The recent news flow says that the EU works on a compromise with China, that they just agree on kind of minimum prices. So if the Chinese want to sell cars in Europe, then basically that then a minimum price gets charged instead of a tariff. The advantage for the Chinese OEM would be that the tariffs are a cost burden, and the minimum prices mean that the margin that they do in Europe is a little bit higher. That could be the compromise, but it's unclear at the moment when that comes, if it comes. I also heard that some minimum import amounts could be set, but yeah, let's see.
Horst, is there a worry that actually the Chinese automakers will come into full force, medium to long term in Europe? And what does that mean for the European market? More competitive and harder for European car makers?
Of course, that's the ambition of the Chinese. I mean, the production capacity that they have got in China is big enough. We know that. the technologies that they have is very compelling. I was always saying that the Chinese can offer an EV at something like 50% of the prices that car makers charge here in Europe. The Chinese would not have a problem without tariffs to offer vehicles at the price of kind of 10,000 euros. If you look at the Shanghai Auto Show as well, what innovations have been presented in terms of charging, autonomous driving, etc. They've got the most competitive product, and of course they want to export that product. It's a story that has been written decades ago by Toyota, by Hyundai. They want to repeat that, and they have got the product to repeat that, and that frightens the European Union, of course, and therefore they are establishing some thresholds, but also the Europeans do not get along without Chinese batteries, Chinese parts, for example. So therefore, it's a very tricky question, but long story short, the Chinese, they want to take market share in Europe long term. It maybe takes a bit of time. BYD is establishing local production in Europe in 2026. It's a matter maybe just of a few years.
All right. Horst, thank you so much. Horst Schneider, the head of European Automotive Research at Bank of America. More on tariffs next. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. China promises more support for exporters as data suggests that cargo shipments have fallen by as much as 60% since the U.S. imposed 145% tariffs on Chinese goods. Shares soar in Banca Generali, the wealth management arm of Italian insurer Generali, after a surprise takeover bid by Mediobanca. Plus, voting set to begin in Canada following an election campaign shaped by Donald Trump's tariffs and his calls to make Canada the 51st state. Now, in other news, Ukraine's president says he's hopeful for a, quote, reliable and lasting peace. That's after he met with President Trump ahead of the funeral of Pope Francis on Saturday.
They have a tough road ahead, okay? And we had a good meeting. It was a nice meeting. It was a beautiful meeting. I'll tell you, it's the nicest office I've ever seen. It was a beautiful, beautiful scene. But he was very, look, he wants to do something good for his country. He thinks he's doing a good job, and he's working hard. We'll see what happens.
Let's get straight to Greg Sullivan, our Russia economy and government editor, who joins us now. Greg, thank you for joining us. Trump met with Zelensky over the weekend. It was an absolutely incredible meeting with incredible pictures coming out of St. Peter's Basilica. Does that bring us any closer to peace talks?
Well, on the one hand, we heard from President Zelensky somewhat of an optimistic note, saying he was hoping for a calm and sustainable peace. We've heard from President Trump that he believes the two sides are close. However, his own Secretary of State, Marco Rubio, sounded a more cautious note over the weekend. He described the upcoming week as critical to the negotiations, but said there is still work to be done. Also, after that meeting with Zelensky, we heard from President Trump on social media. He was actually criticizing Putin, saying that he wondered if he really did want peace or was just stringing him along, and criticized him for missile attacks against Ukraine. Those, of course, have continued throughout the negotiations, with one of the largest airstrikes, the largest airstrike this year, happening just last week against Kyiv. So it does seem that there's still some work to be done ahead.
Greg, North Korea has also confirmed for the first time that it deployed troops to support Russia's war in Ukraine. So what are the implications of this?
Well, yes, it's something that has been long known that North Korea has been supporting Russia's military effort, both with troops in the Kursk region as well as military ordnance. It comes after the two countries signed an agreement on mutual defense support last year. Now, of course, we have both sides saying that, yes, North Korean troops have been involved, acknowledging it, with the Kremlin even thanking North Korea for their help. Both sides do seem to be signaling that this ongoing military cooperation will continue. Another facet of this, of course, is that over the weekend, Russia claimed that it had expelled the final Ukrainian troops from the Kursk region. Ukraine, of course, had been hoping to use that foothold in the Russian Federation as a bargaining chip in negotiations to strengthen their hand. They still deny that the troops have been expelled, but if that does indeed turn out to be the case, that does take away a crucial bargaining chip for the Ukrainians.
Greg, thank you so much. Greg Sullivan there, our Russia economy and government editor. Now, in Canada, a man has been charged with 8 counts of murder after a car rammed into a crowd in Vancouver on Saturday night. 11 people were killed and more than 24 were injured in the attack at a Filipino street festival. Now, the suspect has been named as 30-year-old Kaji Adamlo. Police say he was known to them and they're confident it was not an act of terrorism. Canadian voters head to the polls today after the snap election called last month by the Prime Minister Mark Carney. Now, the Conservative Party, led by Pierre Poilievre, was leading polls by about 20 points when Justin Trudeau announced his resignation in January. But since then, the race has tightened under the new Liberal leader and economic anxiety over President Trump's tariff war. So we're now joined by Ross Matheson, Bloomberg's EMEA News Director. So, Ross, thank you so much for joining us. Today is voting day, so we won't talk about the polls, but what do we know about the 2 main candidates?
Well, we do know, obviously, as you were saying, that Mark Carney took over as Prime Minister and as Liberal leader only recently and immediately moved to disassociate himself to some extent from the policies of Justin Trudeau. He rolled back some issues around capital gains tax. He indicated he's open to drilling, to expanding an LNG export terminal. So he's trying to shift himself away from being associated too closely with Justin Trudeau because, of course, Justin Trudeau's policies were unpopular generally with Canadians. We could see the concern about the economy was there well before Donald Trump took office in the US and instigated all these trade tensions with Canada. And so there's fundamental structural issues there for Canadian voters around housing, affordability, the cost of living and immigration. So that's Mark Carney saying, look, I'm a steady hand at the tiller here in difficult times. I've been at Goldman Sachs. I've run central banks. I know how to deal with these complex issues and how to deal with the US. Then you have the Conservative leader, Pierre Poilievre, who's just saying, like, still popular in the western parts of Canada. That's the bedrock of the Conservatives, but has struggled to set out a policy agenda that's quite different and would show what he would do, again, to steer Canada through some very difficult times.
Rosa, has actually President Trump and the tariffs, has that changed all the election?
We can certainly see it's been a factor in the campaign for voters. The question is, on polling day, what does it mean? I mean, for many Canadians, it's this very personal issue in a way. It feels like the US-Canada relationship breaking down for them is a very emotional one, and they see it as a key one for them as a result. But do they vote with that and therefore possibly towards Carney? Or do they vote still on those fundamental bread and butter issues around immigration and so on? And do they look at Mark Carney and say, well, he's not really that different fundamentally from Justin Trudeau? And so that's going to be the question. But, we're expecting, obviously, to see the possibility of Carney winning, and whether that's a majority or minority government is probably going to be the key.
Thank you so much, Ross Matheson, there, of course, our head of the EMEA News Desk. Now, we're also joined by Susan Lejeune-Dalgresque, former British High Commissioner to Canada. Ambassador, thank you so much for joining us. So, first of all, what are the conditions you think to restart these talks on the Canada-UK trade deal?
Well, I think this is the moment to do it. And I think one of the things that both sides have to think about is where their fundamental interests are at the moment. And I think from the Canadian side, it has been an issue for many years, decades, that they needed to diversify their trade relationships. They are hugely dependent on the United States. And as you know, the UK was very close to securing a free trade agreement with Canada, and then the talks broke down. Canadians need to look at being proper free traders, I think. Some of their protectionist policies are really damaging to exporters from the UK, for example, for exporting dairy products. And I think they need to look very carefully at now using this opportunity to really tackle some of these fundamental issues.
I mean, the new Canadian government, we understand, no matter who wins, wants to build stronger ties with the UK and Europe. Is there appetite, or how much appetite is there amongst the leaders in Europe?
I think there's huge appetite, and I think Mark Carney already set the stage for that when he came to the UK and to France on his first overseas visit. That was a huge change for a Canadian Prime Minister not to go to the United States. So I think he sent a very clear message at that point. And I think on both sides of the Atlantic, there is a clear recognition that when we can't rely on an unpredictable partner in the United States, we need to look at strengthening those relationships where we do have lasting and dependable partners with whom we can work on some of these fundamental issues, whether it's trade, whether it's defence and security, whether it's immigration issues, across the board climate. we need to look at working with people who at the moment are on the same page as us.
When you look at the Canada-UK trade deal, what do you think are the main sticking points right now?
Well, I pointed to the dairy issue. Canada has a hugely protectionist policy called supply management, which protects their dairy industry. I think that has been throughout all the talks when I was in Canada and remains the sticking point. I think there are also issues about movement of labour, but I think this is the moment to really sit down and bash those out. I think one of the other things is that the Canadians are brilliant trade negotiators, and I don't necessarily think that the UK has always been up to the mark in presenting teams which can really engage at the same level. We relied for many years on being part of the European Union for our trade relationships, and I think this is also a moment for us to look at how we can develop the really high level of trade negotiation skills that we need to have these sorts of conversations as an equal partner.
I mean, the UK Prime Minister is towing this fine line of, trying to support Canada whilst at the same time trying to keep strong ties with Donald Trump, who he doesn't want to upset for fear, I imagine, of retaliation. Does he need to choose between the two?
No, I don't think he does. I think it's quite possible to do both. I think you can very easily have a strong relationship with the United States. And again, it's in both of our interests to keep trade flowing and particularly to have a reasonable and adult political relationship, particularly on the big issues affecting us in terms of geopolitics, Ukraine, the Middle East, and so on. But at the same time, I think it is time to spread our attention and our efforts a bit more widely, and to look at some of these partners who I fear have been a little neglected or taken for granted in the past.
Commissioner, what's the right way of Canada dealing with the trade war and dealing with Donald Trump?
Well, I think Canada have some quite strong cards in their pocket that they can use. And the two economies are so closely interrelated that if it completely breaks down, the US will suffer as much as Canada, because cars pass back and forward across the border many times before they're completed. So if that stops working, then it's the US car industry as well that suffers. I also think Canada has some pretty important cards in the energy space, where a lot of electricity and raw materials for energy production come out of Canada and support the US economy. So I think the Canadians can afford to play a little bit hardball on some of these things. And I think what Mark Carney has already done is shown that he's prepared to be strong and shape up to Donald Trump and not allow himself to be backed into a corner.
But if you look at, the threats coming from Donald Trump, does it mean that we'll have an almost new G7 country coming at the forefront of international issues? I know that it was quite significant also to see that decision on Canada increasing defence spending. So how different will Canada look like in 1, 2, 3 years?
Well, I would hope that it will look very different in terms of the role it plays on the international stage. And the Canadians in the past have been a really useful part of the international scene in dealing with some really difficult issues. But if you look back, the last time I think where they significantly played an important part was in the post-genocide period in Rwanda, where Canada really stepped up and played a very, very important role at a terrible moment. Now, we haven't seen a lot of that since. Canada has been very domestically focused, and I think they are a really admired partner. Their values are admired across the world, and I think this is a time where they could step up and really start to play an important role in some of these big issues which are affecting us now.
Thank you so much, Susan Lejeune-Dalgouchek. They're the former British High Commissioner to Canada. Now, coming up, despite today's flurry of offers, the M&A market faces uncertainty as investors navigate tariff risk. We'll be joined by Richard Madden from the investment bank DC Advisory to discuss where we go from here. That's next, and this is Bloomberg.
Earnings season is here.
European earnings kick into high gear.
Beginning to gather a little bit of momentum.
Bloomberg is first to break the numbers.
Netflix or Meta.
SAP as well.
ASML reporting a big miss.
With the smartest insights.
Is it possible for the earnings story to dominate?
Look at the resiliency behind the numbers.
Earnings may even flip into negative territory.
The volatility of earnings really matters now.
It's like a marathon of earnings.
Continuing coverage on Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, EY Item Club says the UK economy will grow half as quickly as previously expected in 2026 as Donald Trump's sweeping tariffs hit business investment. Now, the influential forecaster has warned that shrinking exports and more subdued household spending will hit the strong pickup in growth previously projected. Now, EY Item Club, which uses the UK Treasury's economic model for its forecast, downgraded its growth prediction for this year from 1% to 0.8%. Now, DoorDash is offering to buy UK-based Deliveroo for $3.6 billion. A filing with the London Stock Exchange shows DoorDash proposing a cash offer for Deliveroo's shares at £1.80 apiece. Now, DoorDash has 2/3 of the restaurant delivery market in the US, and a deal will help it expand into the UK and elsewhere in Europe. Airbus has reached final agreement to take over some assets from Spirit AeroSystems, clearing the way for the struggling U.S. aerospace supplier to be acquired by Boeing. Now, Airbus says it will receive $439 million to take on loss-making facilities that produce parts for the European plane maker. Now, the Airbus deal is a key part of a complex three-way transaction that reunites Boeing with Spirit, an operation that it spun off in 2005. Now let's talk M&A, and market uncertainty is creating challenging times for M&A as deals are being postponed while investors wait for clarity around tariffs and geopolitics. Now joining us now to discuss all of this, Richard Madden, European Executive Chairman at DC Advisory. Richard, thanks so much for joining us. I mean, there's a lot going on in M&A, or is there? Because actually when you look at tariffs and some of what the banks are saying, they're pulling off. What are the chiefs saying that PE firms can do and will do?
So it really has slowed down, but it was actually tough before tariffs. If you look at the first quarter of this year, it was down 28% in deal volume on the prior year.
Yep.
And then a kind of tariff tornado has swept through the market, leaving people really uncertain and really unsure and lacking in any confidence at all.
So what happens next? I mean, how much are investors in PE funds actually complaining about the deal-making drought?
So essentially, what happens next will be driven in part by strategics, and you can see that with the DoorDash Deliveroo deal. But if you look at what's the engine of the market, it's private equity. Because private equity, it's part of their business model. They buy businesses, they improve them, often by doing more M&A, and then they sell them. So they're drivers of the M&A activity. They were under some pressure to increase that. They're years behind schedule in terms of their realizations and their investments. But now, I just think it's a very brave firm that says, I know the valuation, I know the future, I'll do a deal now.
So, Richard, what does it mean for investors? They move away from PE and invest elsewhere?
So it's slow for them because essentially they make a commitment to PE, and that's a commitment for 10 years. And so you can already see that they're getting a little bit anxious about private equity, and there are fewer funds going into private equity. But what's there is locked there. And therefore, there are many years of private equity-driven M&A still to come.
But when you look at the drought, I mean, again, tariffs at some point, we assume, will settle. Or will they?
Oh, I hope they do. No, I'm sure that they will. And then people will have a position of confidence. But it will take them a while to feel that confidence. And then again, it takes a while for an M&A deal to happen. It can take 9 to 12 months from the moment you decide to sell and the point at which you sign a deal. And therefore, I think what it means is that M&A activity will be very subdued for this year. If we get some certainty by the summer, then it'll pick up towards the beginning of 2026.
And does that mean hiring, or does that just mean firing at the moment and then maybe picking up when things, pick back up?
I think most people will hold the line because they know that their market will come back. It would be quite brave to say that it's not coming back. So I think for a while people will hold it. If there is a prolonged period of inactivity, then people will have to think about their costs.
Richard, how's fundraising in PE going?
It's been tough. It's been very tough. So, as you say, investors have been looking away because private equity's had 10 really good years, really, really strong growth. But as you look forward, it's not certain that it will be as good. There's quite a lot of fully valued assets in portfolio, which means when they're sold, it'll be disappointing. And therefore, as investors allocate capital, less of it will go to private equity.
If you're a private equity in the U.S., do you do worse than Europe? Again, do you break it down region by region, depending on valuations, but also, I guess, the uncertainty out there?
So the pools of capital are much, much deeper in the U.S. It is a much, much bigger market. I don't think there's a huge difference. What we have seen is a lot of U.S. funds coming into Europe, not just to invest, but actually setting up their own operations and their own businesses here. I don't think that will be discontinued because people are looking for opportunity wherever they can find it.
Yeah, I mean, Richard, the problem is that people are buying gold. I don't know whether this changes everything, right? I mean, there's so much that investors are asking such a big premium to invest in U.S. assets. Does that filter through also M&A companies, or are they going to get less business if you're a U.S. bank trying to do M&A?
No, I do think there is a continuing perception that Europe is cheaper. And it is true that Europe is cheaper. On any measure, Europe is a cheaper market. But then the prospects for Europe are more challenging. And therefore, I think the market's broadly relatively fairly and evenly priced. But we'll see.
OK, is there a sector that looks ripe more than usual? I mean, we've been through a lot of consolidation. The Italian banks, by the way, are absolutely on fire.
Yeah, well, Italian banking is the most extraordinarily fragmented sector, so it's been crying out for consolidation for years and years. So that will take Italian banks and say yes to Italian banks. Elsewhere, I think defence has to be a positive sector where spending will go up. Yeah. And if you look at those big secular changes, healthcare is another, where with an ageing population you have to believe that those are investments that will pay off over the medium term.
Yeah, the problem with defence is that it's also national security. So how much appetite will there be from regulators or even politicians to let it consolidate?
I think there'll be a lot of domestic-related investment because I agree with you. I think we are now much more aware of the need to protect our national assets.
Yeah, is there? I mean, we had a good conversation last week about the fact that, you know, as trade is redrawn, that means that it's only friendly countries that will do deals together. Does that extend to PE and M&A?
Yeah, I think it does. I mean, I think less so. And I do think people are looking now at Chinese investors more positively than they have been. And there are a significant number of Chinese private equity firms that are showing interest in Europe, and the door is not as closed as it is in the US for them.
What about the UK? Where does the UK sit? M&A? No M&A? PE? No PE?
I think the UK is a very deep market for PE. It's the deepest market in Europe, and the sector is most advanced. In Germany, there are half the volume of deals in PE than there are in the UK, even though it's a much bigger market. So I think the UK continues to be a friendly market for private equity, and the industry has generated a lot of wealth for individuals, wealth for investors, and high-growth companies, and I think that will continue to be the case.
Richard, thank you so much for joining us. Richard Madden there, European Executive Chairman of DC Advisory.
Thank you.
Now, many of Europe's largest banks report first-quarter earnings this week with the trade war and market uncertainty in focus. Charlie Wells is here with a preview. Charlie, so away from the Italian banks that have our focus and attention 24 hours a day, what are analysts expecting from lenders this week?
So, Francine, the big question is, do some of the patterns that we saw from these large Wall Street banks, did they translate on this side of the Atlantic as well? Do we get that kind of boost to the trading teams from the volatility? Do we see a deal slowdown across these European banks as well? I think if you take a look at Deutsche Bank versus UBS, you see some of these themes, right? Deutsche Bank boosted by this promise of German defense spending, UBS kind of under the cloud of some of that capital uncertainty from Switzerland. So a potential narrative shift here compared to Wall Street.
What were the big surprises last week?
I mean, look, so we've been talking about the trade war, and I think the simplistic take has been if you've got a trade finance unit, if you're exposed to trade, that could spell bad news for you. But actually, BNP reported higher volumes in their trade finance unit than I think a lot of people had expected. And this could speak to this idea that, yes, we are in the midst of a lot of uncertainty on trade, but companies actually need help with this, and that could boost some of these business lines at these banks.
So banking regulation, of course, really emerged as a key theme for this season. And how's that conversation shaping up?
Such a hot topic. So, in recent days, we had some of the CEOs of the largest banks in the UK writing a letter to Chancellor of the Exchequer, Rachel Reeves, saying they want to end ring fencing. They say that this, hurts them on the global stage. That's going to happen in the UK. Meantime, in the US, of course, you've got this pushback on regulation, this hope in the Trump administration that this could finally take center stage. But at the same time, that issue in Switzerland of capital requirements. So it feels like the winds are kind of changing a little bit, and executives are really pushing back on a lot of these regulatory issues.
Charlie, thanks so much. Charlie Wells there with the very latest, of course, on earnings. Now, coming up tomorrow on Bloomberg, our exclusive conversation with the Goldman Sachs chief executive, David Solomon. Catch that interview at 10:30 a.m. London time. We'll be actually in Norway. I'm flying over this afternoon to do that interview. Now, in the meantime, European stocks rising ahead of a week of major earnings, but also major economic data points. Investors really watching for signs of progress in trade negotiations. Now, key companies reporting this week will be scrutinized for earnings impact of U.S. trade policies, and so that could also shift the Fed thinking, or some of the Fed presidents thinking. We also have fresh readings on the American economy that may support hopes of earlier than expected Fed interest rate cuts. And then again, investors just watching out for any sign of progress on the U.S. trade negotiations. At the beginning of the program, we spent quite a lot of time talking about the fact that China said, look, there's no active trade negotiations, which is a different story to what we heard from the Trump administration that also says they've been working on bilateral trade deals with 17 key partners. The Trump administration also saying they're drafting a framework to handle negotiations with about 18 countries in total. Up next, a Bloomberg Brief, and this is Bloomberg.